everybody. Welcome to another round of the 1Mby1M podcast. I'm here with Spencer Crawley from London. Firstminute Capital is the firm, and we're going to learn about their investment thesis in today's conversation. Spencer, welcome to the show.
Sure, Anna. Thanks so much for having me.
So tell us about your firm. Tell us about yourself. Let's get acquainted.
Definitely. So we're a new seed fund, because obviously that's what the world needs, is more new seed funds. And so we're based in London. We launched last summer of 2017, and we're $100 million size, and we're backed predominantly by tech entrepreneurs. So we have about 50 founders of technology businesses invested in the fund, of which we're proud and energized by the fact that 30 of them are unicorn founders. And then we also have a couple of institutional investors, such as Tencent from China, and some others, mixture of kind of tech-savvy CEOs and family offices. So the DNA of our investor base is hopefully a slightly unusual one.
That's great. And so tell me a little bit about how did this come together? How did you get to these 30 unicorn founders? Where are they from? What are they European unicorns? Are they international unicorns? And what's the genesis of the firm?
Definitely. So we went to them with a mandate of saying that we wanted to turbocharge seed investing across Europe, and also allocate a third of our fund to U.S. companies when investing alongside friends and funds that we know well on the East Coast and on the West Coast. The context was, well, I guess it helps having a much more successful and legitimate co-founder in Brent Hoberman, and Brent is a well-known figure in Europe who started lastminute.com back in 1998, IPO'd that 2 years later at the height of the dot-com boom, and then sold that business in 2005 for just over $1 billion. So that was one of Europe's early really kind of successes in the digital space. And he then went on to co-found his co-founder of lastminute.com was an amazing woman called Martha Lane Fox, who's now on the board of Twitter and many other things. And then after that, he went on to co-found a cluster of other businesses, one of which is made.com, which has been a big e-commerce success here in Europe. And then Founders Forum was an event for entrepreneurs that he started in 2005, 2006, that has been going since, and has started to build out a cluster of other companies, all under a founder's umbrella, including a consultancy or recruitment firm, Europe's largest incubator accelerator, etc., as well as starting a seed fund called Pro Founders in 2009. So there was, when we went to market in 2016, there was a sort of 2-decade plus hinterland or context of Brent having been a leading figure in the tech ecosystem here in Europe, and so that was really the kind of the call to arms to these tech founders was to say that we would love to create a fund that can help the founders that we back have a competitive advantage, an unfair competitive advantage. So that's really how we saw it.
Very interesting. I just looked up Brent on LinkedIn, and he and I have 331 mutual connections.
I'm surprised you haven't met before, Farah. when you come to London in a week or two, you must meet.
Anyway, so all right, let's talk about your definition of seed. Tell us about what do you like to invest in stage-wise, and how do you define seed? And I'll pre-qualify that question by giving you some context. You know, we're, at least in Silicon Valley, seed has fragmented. You know, seed has fragmented into pre-seed, seed, post-seed, pre-Series A, small Series A, and then the traditional Series A. So how does it look like from your point of view and the European landscape?
In this week, I've heard seed twos, mango seed extensions. So I think the semantics here have got very imaginative. But I think for us, we set up the fund to be deliberately opportunistic. And by that, I mean both invest in the best founders that we see anywhere, but also to be nimble in terms of being sector agnostic whilst having and holding deep theses across a number of areas. But we really wanted to be able to kind of be agile and be able to back founders wherever we see them. So that's meant in terms of stage, to your question, we have invested in founders pre-product, obviously pre-revenue, who we either knew and had some kind of informational advantage, or we were blown away by, and so that's obviously been first money into the business, and some of those valuations are high because of the founders having successful backgrounds. By high, I'm thinking in the sort of $15 to $20 million post money range. We have seen some of those, and those are really high, successfully sort of repeat entrepreneurs who have a really impressive track record, and kind of there's a clear understanding of why they're going after that particular space and why their skill set might be suited to building a really giant business. Then obviously we've invested in rounds where we're the first money into a business at a much earlier valuation, or a lower valuation, I should say, and that stretches to businesses that have been going for some time. An announcement we made just 2 weeks ago is in a business called Futrli, Futrli. And when we met Hannah, the founder, she had already was on a £2 million ARR run rate and had been growing the business for several years, had a reasonably large team, and had bootstrapped the business effectively to date. So there's a range that we've done, and I think we avoid getting into full-blown Series A sort of scraps, just because it's we're a decent-sized fund for a seed fund, but obviously in the scheme of global venture funds, we're small, so we avoid A rounds in general, but we have done the odd what you might call very early A. But otherwise, seed for us can mean any of the tags that you and I just rattled off before.
And what size checks do you like to write?
In general, I'd say we're gravitating around the $1 million mark.
Okay.
We've written larger tickets. Our largest ticket was £1.5 million, so just under $2 million. And we have gone down to tickets of $250,000, but we tend to do those less frequently now. We did one or two in the kind of early days of the fund when we were finding our feet and our voice as a fund and scaling out the team. But I think unless it's irresistible, we're unlikely to do tickets certainly below $500,000, and we'll really put most of our efforts into writing the kind of ballpark $1 million ticket.
Okay, terrific. So let's talk about geography. You said pan-European, and also a third of the fund is allocated for American deals. So I'd like to parse that a little bit. Pan-European, or really pan-European, you would invest anywhere in Europe, yeah?
Yes, and until March the 29th, UK is included in Europe, in the EU. So we very much see ourselves as pan-European, and we've made investments into companies that are based in Paris, in Porto, in Warsaw, in Berlin. We're actively looking at a business in Stockholm at the moment. We have a good range of strong relationships with some of the top founders, but also angels and VCs, early stage VCs in some of the key geographies across Europe. So our view there is that in general we will be looking at European businesses that have a continental ambition. So we'll, even in the larger markets such as France and Germany and the UK, we will tend to back businesses that want to scale across different geographies. And so therefore we think we can hopefully help any European business with a layer of connectivity and support. So it involves a reasonable amount of travel, and we have probably a team that's on the larger size for seed, but that's to help us cover the ground effectively and really leverage relationships with some of the key players in those respective geographies. Okay.
Interesting, because we just announced a partnership, I don't know if you've seen it, with EIT Health, the European Institute of Technology and Innovation, their digital health part of the accelerator, and they are going to be accelerating 115 companies with us. So the first 15 has been named, and the next 100 are going to be named in early December. So we are seeing a lot of activity.
On your blog post, it seems. How did that come about? That seems really impressive and exciting.
Well, we have very deep connections in Europe. I am married to an European, and in fact, my husband Dominic Trampin was Steve Jobs' right hand at Next, and he's on the board of one of your British media conglomerates, DMGT, the Daily Mail General Trust Group. So
as I'm talking to you, I am actually in Northcliffe House is the building.
I go there often too.
Yeah, that's where I am, the 4th floor of Northcliffe House. So.
All right. So no, you know what you're talking about, and so Dominic, knows a lot of people in that sector, and also his alma mater is Leuven University in Belgium, and the Konrad de Backer from Leuven is very, very involved in EIT. He's on the board and of EIT Health and so forth. So that's how this all came about. And, one thing led to another, and we started working together. So it's been a really, really nice partnership in that, we kind of are exactly what they needed in terms of their evaluation. They were looking for a deep curriculum and a deep network. And we have all of that, and it's been around for now a long time. So it's been a very, very interesting partnership to develop, and we just announced it a couple months, actually just a little over a month ago.
And is it as a sector? Is it a particular passion of yours? Is it a sector you've been looking at for very closely for a long time?
We only do technology and technology-enabled services, and that's IT, not biotech, not clean tech. So digital health within the IT sector is a very big sector. So we go wherever the trends are. I believe personally that digital health is a gigantic opportunity for the next decade. And, whether it's applications of AI, whether it's applications of various kinds of monitoring, big data, et cetera, there's a tremendous amount to be done in that segment. So it's not so much personal passion, it's just a very clear observation that that's an area, that's a problem domain that needs to be solved. And I think there's so much that should be done, could be done, that hasn't been done yet. Those kinds of segments tend to yield very good venture investments, very good entrepreneurial outcomes. Okay, so in that sense, yes, it is a passion. My passion is anything that can be a good business for my entrepreneur community.
I hope it means that we get to see you much more often in Europe and in London.
Yeah, and absolutely, and also we should look at some opportunities together. Absolutely. Yeah. So speaking of sectors, what are your sectors? Where are you looking, and where do you want to place your bets?
We've been broad to date. We have invested in a range of businesses from a company based in Cambridge here in the UK building software for self-driving. They're actually in San Francisco this week. We have backed a number of D2C businesses, from a UK fuel delivery business called Zebra to a couple of others in the more traditional e-commerce world. We have backed a wireless charging platform called Chargify, which we invested alongside Intel and Hewlett-Packard. We have backed a number of businesses in the blockchain space, some of which are steadily coming out of stealth as we speak. We have started to look closely at two operating systems. One in the synthetic biology space, and which is building a programming platform. We have looked. I'm scanning across the geographies in my mind. We've invested in an exciting gaming business in Germany. We have looked at a number of businesses across. When we think about AI, we tend to look at and horizontal AI businesses that are attacking a very specific use case. And so one in NLP, in natural language processing, which is working with one or two of the larger banks here in the UK. And yeah, it's been, I think, for us there, and it's now got to a stage of the fund's life, a year and a half in, where there are probably 3 or 4 sectors where we're spending increasing time because we feel we're super excited about the space, but maybe haven't placed as many bets as we would have liked. And so we've been spending quite a lot of time in the last couple of weeks, both on food tech as an area, and also kind of digital health broadly, something we've spent a lot of time as a team on. But I think there's an interesting dynamic there with the NHS here in the UK, which is obviously a giant entity, and can have quite a high barrier to entry sometimes. The flip side of that being that if you can crack distribution through the complex web of myriad NHS entities, then that's also a very big opportunity. So I would say, as you can tell, it's been certainly been broad. We've also we backed in Tel Aviv. We backed a cybersecurity business focused on medical devices. We did the seed for that, and one of the leading Israeli funds followed us in the A round. So we've it's been I think we as a team see ourselves as generalists. There are obviously areas where colleagues start to focus more on particular areas, but I think we remain resolutely generalist and founder driven as a fund, as opposed to sector or thesis driven, I would say. Okay.
What are some of the highlights of your portfolio, firms that are startups that are doing really well, and tell us about what stage and what condition did you encounter them in when you chose to invest in them, and what is it about them that struck you, that caused you to place the bet?
Sure. I have to think through my head which are public and which are not now, but some of the ones that to take an example, the gaming business I mentioned in Berlin, a business called Klang, that's Klang. We invested in the A round at the beginning of this year. A colleague of mine, Elliot O'Connor, sourced that business actually by trailing through a list of 2,000 names at Slush, the conference in Helsinki that you'll know well, and he met them there and started to open a dialogue with them and building the rest of the team. They're building an MMO, a massively multiplayer online game, that they are now, their initial title is called Seed, and the business was founded a couple of years ago, but we felt timing had become really very interesting, and when we met them, they had success with an initial title, but we're really now looking for funding to double down on the team and work towards their vision as a desktop game on how to create a world that was evolving and is immersive, not in the VR sense, but in the experiential sense. And within about must have been about 5 or 6 months, they had a strong Series A round that was led by Northzone, the European VC fund that backed Spotify, as well as some other great investors like Makers Fund, which is a strong gaming fund, spun out of Tencent. So I think there's still some way out in terms of publishing the games that they want to, but they really, to us, had felt that they proved a lot by attracting great talent from some of the largest and most relevant players in their space, and that was, I think, an example of something where it felt in a way, as a parallel, it felt like kind of backing a Hollywood studio to produce a big hit, as a sort of loose analogy, and we really believed in the founding team's ability to now that particularly with the additional funding that's given them a runway that is sizable, we think the next 2 years could be really exciting for that business. So that's an example, relatively unusual one, of whereas I'd say probably the majority of our investments were either referrals from founders, or from our investor base, or from the relationships that the team have kind of cultivated. That was more of a finding a needle in the haystack from one of my colleagues. So I would say that perhaps is not necessarily a typical example, but one that at least feels like it's very much on the right track.
Cool. Now, give me a sense of how you think about unicorn hunting. In Silicon Valley, most VCs are unicorn hunting. You happen to have a fund size that allows you to do not just unicorn hunting, but also you could be investing in companies that would have, be built in a capital efficient manner and could have 200, 300 million exits, and you could still be making tons of money of those kinds of deals. What is your perspective on the general sense of exits, unicorns, etc.?
Yeah, it's a good question, because I think it's not always as obvious as it might seem. I think that we would lean on the side of the sort of accepted wisdom that you would you want to be investing in businesses where you can see a plausible, if unlikely purely just in terms of probability, nothing more, but a plausible path to an outcome that would result in returning the fund, and that's obviously going to be a factor of the ownership that you have when that business exits, whatever that exit is, and so I think we do subscribe to that. I think there are the businesses that often generate the most heated exchanges in our investment committee around those that feel like they have a high probability of a lower exit, nonetheless still a successful of founders who you would absolutely back to build something of substance and of meaning, but of perhaps in the $50 to $100 million range, rather than north of that. We tend to avoid investing in those impressive nuggety businesses, rather than try to take very large ownership stakes. It's unlikely we would do a deal where we try to take 25% of a business on the basis that we think it'll be likely to have a quote unquote smaller outcome. I think we would rather lean on the side of picking really ambitious and kind of relentless and authentic founders going after huge market opportunities at the right timing, being able to build a stellar team around them, and underwrite the risk that way, but nonetheless take a view that this is that a unicorn outcome is possible. It may not be the most likely outcome, but one that we can see a path towards.
So you're, in a nutshell, you're still looking at unicorn exits as the preferred investment thesis.
Correct. The reason I gave you the
I understand the reason.
Slightly waffly answer is just
conventional wisdom of venture capital. So absolutely, yeah. I mean, there's a reason why people speak in unicorns. Yeah.
We've debated it at length. It's not something that we kind of took took as gospel kind of from day one. It's something that we've debated in a lot of frequency, because I think the counter to it is it's always hard to many founders who you speak to who have reached that unicorn status didn't necessarily start their business with that explicit goal in mind. In fact, probably many didn't. It was, it's a more organic process of building a business and scaling and seeing how it goes and what the opportunity costs in life are and how the momentum is, how the market is, and something may go much better than expected and drive people to stay longer at their businesses. So I think, in a way, it is a very VC question in terms of, when you're meeting a seed stage company and they're raising, I don't know, 3 million at 10, to really have a meaningful internal debate on, is this a 200 million or a $1 billion exit, is in a way a little bit academic, because it just the amount of unknowns is so significant. But I think what is perhaps a better way of putting it is it would be a red flag to us if an entrepreneur said, you know what, if I get a 50 million acquisition in a year's time, I'm taking it. Now that may be a completely understandable life decision for an entrepreneur based on return of investment on their time and indeed investors' money. But I think we feel that if that is their goal, or at least if that is their frame of mind as they approach building their business, then that may lead to decisions that they take that optimizes. Perhaps it's optimizing for profit over growth, or et cetera, et cetera. I think it informs decisions that they take in those very formative first 2 or 3 years of the business. So I think it's sort of a little bit hubristic of VCs to get too confident about what outcome they think this business will be. I think it's more of a understanding the mindset of the entrepreneur and whether he or she wants to build something of real scale versus seeing a kind of the door ajar and going for a market gap and saying, you know what, I'll cash out when I can, which is a completely, as I say, a decision that I would respect individual, but perhaps not one that I would want to invest our funds money into.
So, what we say in our practice is, just like it's really important to get product market fit, it's also very important to get investor entrepreneur fit. And what you're saying is basically some investors have different investment thesis, some entrepreneurs have different goals, and so I think you kind of have to align all these goals and choices in life. And an entrepreneur who's taking money from a traditional venture fund should be aware of the expectation that they're going to have to really kind of work super hard and super intensely to get to what they call blitzscaling, right? Really fast growth, 5 to 7 year path to $100 million in revenue kind of metric. And that's a very intense path, and that's a very low probability path, because hypergrowth is not a natural state in business. So that's kind of where we leave this, is that there are many ways to succeed. A company that gets a 50 million to 100 million exit with a capital efficient cap table is also a success. It's just not the success that your firm or equivalent investment thesis firms are looking for. There's no value judgment on it. It's just that's the way it is.
Completely right. And of course, in a portfolio of venture investments, there will very likely be outcomes in that range that you mentioned. It's just that perhaps for some of those, they ended up being $50 million, strategic acquisitions by someone, because that entrepreneur, sweated blood and tears to try to build a $500 million business, but it didn't quite play out for timing or whatever reasons may be the case. So I think I completely agree with how you phrased it, and I wouldn't in any way make any judgment on that front. But I think your assessment was spot on.
All right. On that note, I'm going to say goodbye to the listeners. But Spencer, please stay on the line so that we can talk about getting together in London in a moment. Audience, thank you for listening.
Thank you so much.
And as you know, we have weekly mentoring sessions. You can go to the website and look at free public roundtables and sign up for a slot on that schedule. And suit yourself. Whatever works on your schedule is fine. It's a safe working session. We'll look at your problems and see how to address those roadblocks. And if you're visiting Silicon Valley, or if you're local to Silicon Valley, come to one of the 1M rendezvous in Silicon Valley at Cafe Boroni. And that schedule is also on the website under rendezvous. So one way or the other, see you soon, and we'll be back with another edition of the 1M by 1M podcast.